This is Value Invest Asia, and this is our beginner's guide to investing in the Asian stock market. Class 11. The 3 types of value that you can find in the Asian stock market. Hello, welcome back. Okay, nearing the end, this is class 11. We'll go through the 3 types of value that you can actually find in the stock market. Our usual disclaimer: after many years of investing in the stock market and just talking to a lot of great fund managers, interviewing them and interviewing companies and researching on companies, we realized that basically there are only 3 types of value that can really be found in the stock market. And we categorize them under asset value, number 1, current earnings power value, number 2, and growth value. And we'll go through all 3 of them and what do they mean and how do we actually classify different companies under which type of value they should be in. And the first step in achieving that is not actually going down to look at the financial of the company or doing screen like finding their price to book or price to earnings or tinkering with the discounted cash flow and things like that. The most important thing when we begin to look at a company and decide what kind of value it really is first by understanding the story of the company. Right? People talk about investing is both an art and a science. And this is the art part right here. We cannot just base our investment purely on the financial figures and things like that. We need to, at the first step, find a company where we understand where it's going and we are comfortable and confident of what you can achieve in the future, thus creating a story surrounding this company. And that is, in our mind, the first step that we should be doing when looking for value in the stock market. So let's dive right in. The first type of value that you can find is what we call asset value. And asset value is basically a method we use to value company based on what their asset is worth. Okay, and it is about finding a stock or a company that is undervalued based on what its asset should be valued at. Okay, a simple way to think about it is just think of it as say a real estate investment trust, and they have properties that are easily valued and they're quite current. But if you find them trading at a very, very deep discount to their price to book or price to tangible book value, then this kind of company might be categorized as asset value, because in actual fact, their asset, if we are to take over the company or take over the investment trust, we can liquidate everything and the value of the asset can be realized, but then it is not being realized in the stock market if it's trading at too low or a huge discount to the book value. So this is what we are trying to find. This type of method is made famous by Benjamin Graham. From our previous class, we discussed who he is. He's the father of value investing. And in his first book, Security Analysis, he termed that he liked to hunt for companies that are deeply undervalued. And it is so undervalued that we categorize it as what we call a net company. So this company are so cheap that if we just use their current asset, they are sufficient enough to pay off the entire liability, both current and non-current, of the company. And he can still get it at such a price that he can still profit from the company. So an example you want to think of is a company with current asset of maybe, let's say he has 5 billion of current asset and a total liability of just 3 billion, right? Basically, if you liquidate everything in its current asset and pay off all its liability, you will still have a net cash of $2 billion. But Benjamin Graham can find this kind of company trading in the market, maybe just at a market value of $1 billion. So in theory, you can buy the company, the entire company for $1 billion and just shut down the company, right? Shut down its operations, sell everything, and you will still make a profit just by liquidating its current asset. You'll double your money and you'll get all its non-current asset for free. Whatever price that you can fetch for it is bonus to you. So these are the company that he first make famous. And it's a type of investment strategy still used by a lot of people in the market. But you'll find that finding this kind of what they call net company is quite hard to come by in the current stock market. This is because market has become more efficient as technology evolve. So information flow is much homogeneous now, and it's very hard to come by these kind of companies. And even if you come by this kind of company now, most of them, I would say, has questionable reason for why they are trading such a low price. It could be a fraud, or it could be a value trap where the management has no desire to unlock this kind of value in the company. So it's quite a dangerous place to play, I would say, in the current stock market. But it is definitely a successful strategy and still utilized by many people in the market. Like we said, the key thing to look at is the price discount to its book value. This kind of value is mostly used for company with very liquid asset. You're talking about the banks or maybe even insurance company where their asset can be liquidated or can be sell off, and you can turn back to cash. Or just company with hard physical asset that you can still liquidate, like a property company, or maybe a manufacturing company, but if you can base them not on its operation, but just on what the asset has. So a good way to understand this is, let's go through an example. We have here a Singapore listed company called Hong Kong Land Holdings Limited. It is one of the largest property company listed in Singapore. And as the name suggests, it's predominantly a property company based in Hong Kong. And it is part of the Jardine Matheson Group. If you do not know who the Jardine Group is, I would urge you to make just a quick Google search on the Jardine Matheson Group. It's a long history company since the Opium War, and it's now one of the largest conglomerate in Asia. And Hong Kong Land Holding is one of their subsidiary. We come across this company, and when we research on it, I say the first step is to create a story surrounding it. So what is the company about? When we say it, we are trying to create this story of a company. Basically, I'm trying to answer 6 main questions, right? I'm trying to understand what the business is really about, what is or how big is its addressable market, like where can it expand to, or which market it is already in. We want to look at what we call a SWOT analysis of the company, basically looking at its potential, its strength, opportunity, weakness, and threat surrounding the company. We also want to look at its reinvestment characteristic. Is this company like a high capex business or low capex business? Does it really need to pump in a lot of new retained earnings into the company for the company to grow? Or is the company quite maintenance free in a sense, right? And lastly, after we concluded all the above 5 questions, we have to make a judgment, a subjective judgment on how risky is this company in terms of its business risk, right? I'm not talking about how volatile the stock is, but rather as a business, if we would want to buy it as a private business, how risky is this business in the fundamental levels, right? So let's go through how we do it for Hong Kong Land. You can basically find out most of this information just by looking at the annual report of the company, or just maybe Googling the company, right, and understanding what the company is really about. What are some of the media reports about the company, and you can form where is this company going to, and form a story about the company. So for Hong Kong Land, we will see it as predominantly real estate ownership and development business, right? It is one of the largest building owners in Hong Kong, in the central Hong Kong region. It owns many of the commercial buildings, and actually a large part of its asset is still located in central region in Hong Kong. And so it's almost like a REIT, right? It owns all this great asset, and it's just generating rental for them. But they also have a development business where they're expanding in the ASEAN region, or even in China as well. So that goes on to the addressable market for this company. Currently, it's mostly in Asia Pacific region. It is starting to grow in ASEAN, and has a big presence in development in China. But its traditional business of real estate ownership, it's still located mainly in the city of Hong Kong and Singapore. So these are the addressable market for the company, and I do not see it changing in the longer term. I don't think this company will suddenly become a global player, but rather it will still stick to its core business of being an Asian Pacific real estate powerhouse. So when we look at its strength and opportunity and weakness and threat, this includes scanning through its annual report and some of its financial, just scanning through, right? And doing some of the ratio that we talk about in the previous class of how to measure the ratio and the efficiency of this company being run. And we come out with an opinion on the swap analysis of the company. So on first glance, this company has a really strong balance sheet, right? For a property company, it has very minimum debt. And this is quite unique for property companies because, as you know, property is quite a high capex business, and you need a lot of capital to be in this business. And yet Hong Kong Land Holdings has been able to sustain its business without taking on too much debt. So that's one of the key strengths of the company, that it is not really afraid of a market downturn or anything, because it has such a stellar balance sheet. And it also has a lot of grade A property in its portfolio, both in Singapore and in Hong Kong, a little bit in ASEAN and China. But just looking at its properties, all great properties located in the city center, and it really demands a higher premium compared to the other commercial properties in the region. And they also have the option right now, because of their development business, unlike a REIT where they have to continuously pay out dividend from their earnings. As a company, they have the option to retain that earnings, and they can grow their development business in ASEAN and in China. So these are the strength and opportunity of the company. But looking at the flip side, the weakness and threat, the company also have some weakness and threat. And the main weakness is it has a very conservative management. As we say before, this company is part of the Jardine Matheson Group, and being a family business, and being a family business that has been around for 100 years, they tend to be more conservative, and that is why you see the strong balance sheet and minimum use of debt. And so in a way, it's not going to be a huge growth company at all. And that is why we do not use the growth value type of category to categorize this company. So that one is out. And because of its conservative management, a huge part of value is stuck in its real estate ownership. And that is a plus point that we can use asset value to value them. And secondly, another threat is at this point of time, the property market in key markets such as Singapore or Hong Kong or China, just around ASEAN, is considered quite toppish. And this has been going on for a long time. Government in China and in Singapore has been trying to what they call put in measures to control the asset bubble from bursting. And so we are quite worried about the property situation in its key market. And so that is a threat, that is a weakness. And lastly, just lack of growth due to the top two reasons. And next we look at its reinvestment characteristic. As you know, property business is relatively high capex. It needs to bid for new lands, to develop new properties, and sometimes you're able to sell it, sometimes you're not able to sell it. And so it's rather high capex business. And it's also slick. So from all this, we make an assessment on the overall business risk of the company. And we deem it as maybe in the mid-tier risk region. Is not super low risk like a consumer staple company where they just sell the same thing over and over again, day in and day out, and people will still buy them regardless of the economic condition. They sell a very high ticket item, property, and maybe it's considered one of the highest ticket item that we can buy as a consumer, right? The property. And so these are really affected by how the economy is doing. So it's very cyclical based on the economy. And so it's not really low risk, but because of its very strong balance sheet and a big part of it is just in collecting rental from its prime real estate, it's not really high risk as well. So it's, in our opinion, it's maybe more of a mid-risk business. That's how we come up with the story of Hong Kong Land. And in our next class, we'll talk about how to convert this story into valuation method that we use and how to value this company. At the moment, the story allows you to have a clearer sense of what the business is really about and help you categorize it. So when we look at the story of this company, which category it should really be in? As we talk about, it's not really in the growth category because there's not much growth for this company, right? And it's, if you're talking about the earnings power value of this company, because it's in a very cyclical business, the earnings will fluctuate up and down based on what the economy is doing. You can value it based on the earnings power, but it might be a little bit tricky. So the most direct way to value such a company, and because it already has a huge portfolio of property that you can easily value on the market, the best way to value this kind of company is based on its asset value. And that's what we're going to do in the next class. But at the moment, so just remember how we come up with the story of this company and how we categorize it into asset value. There's pros and cons in using this asset value segment. Some of the things we have to take note is it is really easy to use, right? It's really easy to use once you have the story of the company, and you can. It's easy to value them in the next step. It's quite fast, and you can actually compare its value with many of its competitors, and you can compare it back with its history as well. But the problem is we have to know this kind of value might not be realized in the stock market. And this is something that we have to understand. Because when we say we value a company based on its asset value, we're making a big assumption. And the assumption here is we assume that we have the power or the funds to buy up the whole company and liquidate the company, right? And that's the way to only profit from it, because if we are basing it on what its true asset is really worth, the way you can realize it straight away is if you take the whole company over, and then you strip it and sell all of its asset, you will be ending up with a profit on your investment. But that is a big assumption, because most of the time as a minority investors, we are not able to do that. Okay, and so this kind of investment, you need what we call a catalyst. If we invest in it, do we expect things to change? Do we expect management to start taking more aggressive step to grow, or they are starting to sell off some of the asset and realizing the full potential, the full valuation of its portfolio? We have to think about that. If we do not think about that, it's very easy for us to fall into what we call a value trap, where we know that we are investing in a company that is cheap, and the market know that it's cheap, but it is really cheap for a reason, and that's because the main shareholder or management has no desire to unlock the value. They just want things to be the same, and that is a risk for us.